If you're a beginner real estate investor or just thinking about beginning to invest in real estate, I want to talk to you about some terms that you probably hear thrown around quite frequently, which are cap rates and cash on cash returns. I'm going to start with cap rates because it's a little bit easier to understand, I think, and a little easier to calculate, although both terms have a sort of a separate purpose and they're both beneficial to use and look at. So let's start with cap rates. Cap rate ignores the mortgage. Okay, if there's a mortgage on the property, it kind of ignores it, and it just looks at what is the current value of the property, and then divide that by what the net income of the property is. So all the rents minus vacancy and minus maintenance, minus management, all the things that you spent money on the property, how much net income was left over at the end. So here's a simple example for you. If you had a $100,000 property, after paying all the expenses, property taxes and management and all that stuff, you're left with an $8,000 profit. That would be a cap rate of 8%, which of course would be amazing. Most rental properties right now are seeing cap rates closer to 6%, all right? It depends on the market, but here in the Phoenix area, most investors are pretty happy to get a 6% on their cap rate. Now, the downside to cap rate is it doesn't really factor in your mortgage. If you have a mortgage on the property, it doesn't really help you understand how much money you're making. A cap rate is beneficial to help you analyze how one investment performs against another investment, but it doesn't really help you understand what your actual return on your money is going to be. And that's why I also like looking at cash on cash returns, because I feel like this factors in a little bit better if you're going to be using a mortgage. And it helps you understand, if you're investing money in the stock market, right? If you put $100,000 into the stock market and a year later, your money between your dividends and what is currently in the account is now $110,000, well, you got a 10% return. And that's usually how we think about our money, is what kind of return are we getting on our money? And that's why I like the cash on cash return. Let's just use our simple example again of saying that we bought a $100,000 house and we put 20% down on it. So we have $20,000 into the property. You can add in closing costs and some other things like that, but I'm just going to use that $20,000 to make the math simple for now. So you put $20,000 into it. Then how much money did you make on that $20,000 a year later? So let's say a year later, the value of the property is now $110,000. So your $20,000 that you initially put in has now gone up. You have an additional $10,000 in equity. So you already have a 50% return. You could sell the property, get your $20,000 back, plus get your $10,000 in increased value. So your $20,000 turned into $30,000, right? That'd be a 50% return. But you also have to add in any cash flow that you got from the rent. So let's just say that your leftover cash flow on the rent was $500 a month. That'd be pretty good, of course, but I'm just trying to use nice, round, easy numbers here. So $500 a month, and you had it rented out all year. That's an extra $6,000 in cash flow for the year. So you made $10,000 in equity, and you made $6,000 in cash flow. So your $20,000 created $36,000, because your $20,000 is still there. It hasn't disappeared. It's still in the equity, right? So you still have that, and it gained $16,000. So I can't do that math in my head, but your cash on cash return almost doubled. Your $20,000 turned into $36,000. So whatever that is, a 75% return. That's what the number I really prefer to look at, because it really looks at what you bought the property for instead of the current value. Is interesting to know, and the cap rate is helpful so you can compare investments versus other investments to determine which one is the best. But really what I want to know is, how good is my money doing for me, right? I can put my money in the S&P 500 and I know that in the long run I'm going to get a 10% return. How is my real estate performing versus that? Because if I'm not getting 10% return, then I might as well invest in the S&P. Now, obviously, over the past 2 years, the real estate market has been absolutely on fire, but I can tell you that between the cash flow and equity gains, most of our properties are seeing around a 100% cash on cash return each year. So anytime I buy an investment property and I put $50,000 into it, within a year, between my cash flow and my equity, I'm getting another $50,000 in wealth back. So that's why I love rental properties, actually crushing what the average stock market returns are doing. So I hope you found this a little helpful. If you have a rental or you're thinking about getting a rental and you want me to help you understand what your cap rates or what your cash on cash returns might be, I would love to sit down with you. I've got a spreadsheet for all this on my rentals, and we can share notes and see how you're doing on your properties. And I look forward to talking to you soon.